The intersection of commodities and environmental, social and governance, or ESG factors, present a complex challenge for investors. As broad ideology evolves, investors are becoming more mindful of their impact, including in an asset class like commodities. Some may worry there are drawbacks with the greenification of society, or that portfolio construction sacrifices are being made. So how can one of the oldest asset classes mesh with the ethos of today's ESG-conscious investor? And is there a way to thoughtfully approach investing in commodities with an ESG lens? My name is Neuberger Berman, and joining me today from London are Sarah Peasy, Head of Europe ESG Investing, and Hakan Kaya, Head of Commodities, to discuss some of the key elements of considering ESG when investing in commodities. Sarah, Hakan, thank you for joining me today.
Thanks for having us, Anu.
Thanks for having us.
Now, to start off, you each work in different departments within Neuberger Berman, but you've been working together very closely as you consider this intersection between commodities and ESG factors. So, Sarah, tell us a little bit about why this topic, again, ESG factors as it relates to commodities investing, is important for investors to better understand.
Yeah, absolutely, Anu. I'll kick this off. And we work so closely. We actually sit outside each other's offices here in London. So definitely a crossover in terms of what the teams do. But look, bringing this back to the commodities and the ESG connection, and I think it's a really interesting time for both. And for commodities as an asset class, we've certainly seen a renaissance given the backdrop of the persistent inflation that we're seeing from a macro perspective. However, this has come at a time when, I guess, asset allocation is really facing more of a challenge from an ESG perspective. So in terms of being able to demonstrate outcomes alongside the traditional kind of asset allocation decisions that are being made. Now, from a kind of more traditional perspective, commodities have never necessarily been seen as a very ESG-friendly asset class. But given this increased focus and the fact that we're seeing an interest from regulation propelling ESG forwards, it's an interesting exercise that we thought that we'd undertake to actually seek to understand, can commodities as a solution be considered responsible in some way? And look, typically think of ESG integration from a physical entity standpoint, and we can get to grips with the idea of a corporate or a sovereign, for instance, being considered ESG integrated. But when we come at it from a commodities standpoint, it's quite difficult to conceptualize this, especially when we start to bring in the way that we're actually trading commodities as well and the role in which the mechanism plays around ESG. So this led us to try to synthesize all of this down and think about it, I guess, in a few areas, such as the nature of your exposure to commodities and whether the way that you're actually trading them or speculating on commodities can be considered responsible. And also, can engagement actually play a role in this, and particularly the engagement with the wider commodity market ecosystems? But Hakan, I'll pass over to you for your thoughts as well.
Yeah, definitely. Sarah and I have overlaps. Of course, we share common goals. We do want to live in a greener world, and we are believing in this green transition. But we also see there's no transition pathway that doesn't involve commodities. One way or other, we will have to invest in these commodities. So you see, we have these fiduciary responsibilities, and when you think about, they are inextricably linked to these climate considerations. So this overlap, when you look at this, it's really about the curiosity about bridging this gap. How can we do it? So from traditional ways, the frameworks in stocks and bonds have been there, have been studied, but nothing so far in commodities. Neither OECD nor United Nations have provided comprehensive guidance in this field. So we are curious. And curious first, we would like to understand what can we do that is responsible here. How can we adopt these new investment ideologies? And when we do this, how do we do it properly? And do it honestly without any marketing gimmicks? And how do we integrate these principles in a way that makes logical sense and an investment sense too?
That's great. That's a terrific start. Thank you both. So it sounds like you're on this journey. You're trying to navigate how commodities and ESG play together. How can we do this logically without greenwashing? Your hearts are in the right place. But with that said, we've seen a variety of sort of receptions globally to ESG investing, and commodities appears to have some specific controversies associated with them when it comes to ESG investing. What are those, and how have you gone about addressing some of those?
Sure, Anu. We have several ESG pushbacks, but the two major ones are about one, of course, the carbon footprint, and two, the alleged harm speculative trading can have on society. So on this emissions, obviously, this is an extractive field, and fossil fuels are really in the middle of everything from production to transportation to consumption. So there's really no escape. The field emits, right? And the most widely used practice to deal with this issue is either omit the asset class or divest away from it if you have exposures already. So, the idea is there are environmental risks, there are reputational risks. So why bother? Because I think, first of all, the asset class, it is an inflation hedge, and we saw how effective it was just last year. Stocks and bonds, they went down steeply. You see, commodities, they soared. But besides inflation, I think for the next decade or more, there is sizable diversifying returns potential due to still existing unresolved supply underinvestment issues. Also, you look at it on the demand side, we have several reasons from policy choices to green capex deployment to now geopolitical issues. But on this carbon footprint issue, I think the debate is really about who owns it. Now if you think about it, let's say in oil futures that will mature in the future, one side of the debate says, as a buyer of the futures contract, you own the carbon footprint because at some point you will own that physical oil. But the other side says the underlying crude oil has not yet been produced. It has not yet been consumed. So entering in a contract today, when you look at it, it didn't force a producer to produce the commodity or produce it substantially more. Let alone when you look at these futures contracts, as investors, we never take physical ownership. We never take physical delivery. At maturity, what we do is we roll these contracts. So in a sense, the oil associated with our contracts, it may not even be produced at all. So the carbon footprint ownership is vague. So on top of these, when you think about physical versus financial commodity ownership, these financial markets, the volumes in these markets are multiples and multiples of the physical trading volume. So in a sense, if we believe that futures contracts have commodity carbon footprints ownership, then we are thinking about a system in which the carbon is substantially over-owned. So in a sense, these all refute the idea that the carbon footprint ownership should belong to the derivative investor. So that's one. The second issue that we face with is this societal issues, like there's a belief commodity speculation, they exaggerate prices, especially food prices, and cause a social burden, especially on the income constraint. And also related to the green transition, the idea that investing and buying these commodity futures, they will make green enablers, especially metals, very expensive, again, creating a burden for the society. And there may be some truth to these, but I think here we really shouldn't confuse correlation with causation. Especially if you look at those food riots that we've seen in the 2000s, you can easily trace these reasons back to the conditions of those times and the fundamentals, not necessarily speculators. So in the 2000s, we had China coming in, voraciously demanding commodities. So it's creating this excess demand for grains and food that really created spikes in food prices at that time. And yes, there was speculative activity, but it was driven. It was not the reason the prices really spiked up. I think to the contrary, what I would like to say is this futures trading, it will be essential for the economy, even more so now that we are going into this green transition. And for green transition, you see, these will require large risks and long cycle risks. And really, there should be some sort of like a risk transfer mechanism. And these futures market, they provide it. And only with a transparent, clear forward curve can producers and consumers of this new green economy can make plans and risk hedge around their production or consumption in the future. So for all those net present value investors, a commodity forward curve, a reliable forward curve, is essential for making investments today. So in a sense, I think without deep working, healthy derivatives market, it will be very difficult to go through this green transition easily. And I think investors really, instead of divesting, should become a part of this ecology, provide these pricing signals and liquidity that's needed to grease the wheels of this transition.
Great. Thank you, Hakan. That was very thorough. And maybe just to quickly capture some of those thoughts there, one key message that you had was about who owns the footprint, who's the responsible party here. You noted the financial instrument market, the derivatives markets are multiple times larger than the physical markets. And on that note, thinking about kind of ownership, it makes me think a little bit about engagement. And this topic, engagement stewardship at Neuberger, is so important to our firm in that we strongly believe that the dialogue between investors and companies can influence positive behaviors that we believe will drive long-term and sustainable returns for clients. On that note, maybe turning to Sarah, how does this topic of engagement translate in commodities investing where, as we mentioned, we're using derivatives, futures contracts, etc., for the implementation of exposures, as opposed to securities like stocks and bonds? How does engagement relate to this asset class?
Yeah, no, absolutely, Anu. So, as you said, look, we're an active manager, so engagement is always central to what we do. And we certainly don't think that commodities should be an exception to that rule in any way. Ultimately, the last thing that you want to be doing as an asset owner is to be offsetting the positive engagement outcomes that you might be having through your physical exposure, through credit, through equities, with the decisions that you're then taking through your allocation to commodities. So we think on this basis, engagement needs to be thought of in a more holistic way, especially when you're looking for opportunities to engage with the entire commodity market ecosystem. So this includes exchanges, the producers, the consumers, regulators increasingly playing a role, and even sovereigns as well. And ultimately, the goal of creating markets that are more sustainably sourced from a commodity standpoint. And equally, when we're trying to get this wider adoption for the new green alternatives that are starting to come through. So crucially, we have to look beyond the traditional pathways to engagement. But we also think of this when we're undertaking our engagements in a more traditional sense through our equity or our fixed income exposure. So, for instance, a few months ago, we met with the CEO of a very large mining company, and the meeting was attended from representatives across asset classes. But that also included Hak and myself as well. And we explored a number of financially material topics that were relevant to this mining company, from potential UN violations to water consumption policies, the capex that's being spent on water desalination units, which is obviously increasingly important from a mining standpoint, and even then the expectations that mining company had on future metals, where the miner is doing a lot of work, for instance, on trying to create a greener steel, and exploring the use of electric smelting furnaces that are capable of producing steel from iron ore using renewable electricity and hydrogen. So we're able to gain far greater insights from understanding companies that are consuming commodities as well, which can then help to direct our engagement and also our investment decision-making that Hakan is then taking. So I think a lot can be achieved just by simply formulating more of a united front through holistic engagement.
Terrific. Thank you very much, Sarah. You mentioned engagement needs to be holistic and across the ecosystem, including with regulators, which brings me to the next question. There's been a lot of regulation and oversight introduced in recent years, particularly in Europe, as it relates to ESG policies and disclosures. Could you address any recent or future policy changes that you think could affect the commodities landscape?
Yeah, no, absolutely. Look, it's an incredibly exciting time for geeks like myself and Hakan. And as a result of that, it's also a very compelling market backdrop as well. And we're finally getting the signals that we've been wanting from policymakers in particular, that gives companies the confidence to transition and ultimately commit the capital. And as a result of this, for sure, 2023 is likely to be a milestone in the extent to which green capex is being deployed, which is fantastic when it comes to trying to make progress against these very ambitious goals that we have when it comes to the energy transition. But putting this into context, so last year, the US, they put a really firm flag in the sand with the announcements around the Inflation Reduction Act. And this is expected to deploy anywhere upwards of $1 trillion of green capex in the next decade, if not even higher. And this is coming through the form of subsidies and grants. And this could actually close a significant margin in the emissions gap, which is against the kind of US's current climate targets. So it is going to have a demonstrable impact in what we can achieve from an energy transition standpoint through the US. Now, the US is obviously very pivotal in what we do. The other significant region which is going to ultimately define the success that we have against these goals, of course, is China. And China can certainly not be considered a laggard in any way. Almost every green technology out there, China has a lead on the rest of the world, whether it's solar panels, whether it's batteries, whether it's electric cars, hydrogen-producing electrolyzers. Even over lockdown, we saw copper demand increase, and this was purely down to the record EV sales that we were seeing across China. So China is making great strides as well. And then, of course, closer to home for us, Europe, and it's no secret, Europe has always seen itself as a leader in the green transition. And I think it's fair to say it's felt a little bit threatened as well, particularly this year from the US and China. And this has naturally led to Europe coming up with their own policies as well. A couple of months ago, we had the Green Deal Industrial Plan being finally synthesised down and made public. And I think it's fair to say that the ambitions are pretty lofty in what Europe has set out. A lot of focus has gone into trying to localise production around net zero technologies. But look, fundamentally for me, Europe is always going to struggle to contend with the likes of the Inflation Reduction Act. And this simply is because Europe is not the United States of Europe. Equally, the targets that are embedded into Europe's plans are non-binding. They're largely aspirational, and these all are very local, state-dependent in terms of how the financing ultimately gets rolled out. And this is different to the Inflation Reduction Act, where there's a lot more detail around the amount of subsidies that will be deployed. So companies as a whole have an opportunity to guide and direct their finance in a more structured way. So potentially is always going to restrict the progress that Europe is going to make. But equally, we're getting lots of headlines where different regions across Europe are trying to get more of a handle on this. So from a policy perspective, it's incredibly exciting. Now, from a regulation standpoint, again, I'm going to focus in on Europe a bit here. But from a commodity perspective, there's been some really interesting developments this year. Some of you may have seen that the European Parliament actually voted in favour of a landmark deforestation regulation. And this is ultimately going to prohibit commodities that are produced from deforested land. And these include cattle, cocoa, coffee, palm oil, rubber, soya, even wood. And these will be restricted from being sold into Europe. And these new rules are going to have quite an overarching impact on importers and exporters. And there's going to be this new requirement to produce due diligence statements around how your products were ultimately created and also where they've come from. And again, there are positives to come out of this in terms of policymakers expecting that this is going to have a huge impact on protecting hectares of forest and as naturally also reducing the amount of carbon dioxide which gets emitted into the atmosphere as well. But we also, as investors, have to think of the knock-on effect that's going to have to companies, particularly when it comes to reporting and traceability. Something from a global supply chain perspective we really struggle with in terms of the level of transparency that we can get. And obviously corporates are having similar struggles where they have quite deep and complex supply chains. So it is going to be interesting to see how companies adhere to this and the knock-on effect this will have. But ultimately, that the goal, the ambition is incredibly positive. So it really is all systems go from a policy and regulation standpoint, Anu.
Terrific. And for our listeners, I want to know, Sarah really genuinely is excited about all of these policy and regulatory changes. That is not scripted at all. She really is super jazzed about what's happening. Is that fair, Sarah?
Unfortunately, it really is. I hope my friends aren't listening to this.
Sarah, you mentioned China leading the way with green technologies, and you also mentioned engagement with a company who are focusing on greener steel. I want to turn the conversation to hear a little bit more about other innovations within tradable commodities that might be interesting for investors to be aware of. Hakan, anything you'd like to share on that front?
Yeah, definitely. You see what Sarah said about exchanges. Exchanges are listening and they are very active in creating these new commodity derivatives, new products, right? What used to be a bad commodity like palm oil is now green traceable from Malaysia. They got transformed because of exchange engagements. So this is how it works. These financial commodities that we trade in, they meet physical commodities in the exchange. And investors or a subset or a collective of them can really influence exchange behavior. So you see, we can enforce exchanges adopting green policies like traceability in their warehouses or derivative contracts they offer. So why don't we have a large, deep, working green traceable aluminum contract that's essential for the green transition, which perhaps says in its specification like this is extracted in an environmentally conscious way. Why not? Why don't we have a well-functioning futures contract on recycled metals or fair trade coffee? Most of these, they were unthinkable a few years before, and now we can even talk about these and, impact exchanges. And these were unthinkable also because the commodity producers, they were, in a sense, too vertically integrated to need any trading or hedging, and speculators didn't have any information advantage to join these markets. I think these will change with the green transition, with this massive green capex deployment hitting the space, and information advantage is now becoming available with big data potentials, AI potentials these days to help us investors, right? I think especially related to these green transition, rare metal markets, uranium markets, even water markets, this adoption has to happen. And this can only happen if there's interest and there is willingness to pay the price. And what is the price here? The price is really accepting novelty and the liquidity costs that come with it, right? There are success stories, of course. For example, carbon futures markets, they have largely succeeded. You see here, there was government involvement, there's corporate involvement, there was exchange involvement, and there is investor buy-in too. So stars really aligned. So for other green enabler successes, again, these four need to understand that trading in the underlying commodity, whatever it is, a win-win game. And I'm optimistic that these tools will be available and liquid as we go through time. And so I encourage investors to really understand the logics behind these new indexing tools that are coming into the market these days.
Yeah, sure, absolutely. Scrutinizing whether that's the right way to actually play this asset class, and with these considerations, looking under the hood to make sure you're getting what you're signing up for. Hakan, Sarah, this has been a great conversation so far. As we wrap up this episode, I'd love for each of you to share any final thoughts for our listeners as they consider this important relationship between ESG and commodities. Maybe Sarah, starting with you.
Yeah, no, sure. And look, I appreciate this is perhaps a longer episode for our listeners than they're used to, but I think it just reflects how complex commodities are, especially when we're trying to position them from this responsibility context. So I just would encourage our listeners who have this exposure to commodities to think about not only the underlying commodity itself, but the nature in which the commodity itself is traded as well. And that mechanism also has to be brought into play when we're trying to actually answer this question around the level of responsibility that's being achieved through your commodities. Equally, it's thinking about this element which I touched upon through engagement. And we want to achieve engagement across the wider commodity ecosystem. And we believe that you can achieve this obviously through the different kind of channels that I mentioned, but equally this can be achieved through your more conventional engagement that you're undertaking as well. And this can be backed by the insights that you've gained through your commodity market, supply, demand and pricing. We really believe that a more untapped opportunity that can lead to positive outcomes.
Yeah, I think I'll add on top of it, and if I may summarize, I think in a practical commodity action plan for ESG-aware investors, like keeping in mind this asset class is interesting. It offers inflation protection. It offers return potential due to supply-demand dynamics that can make portfolios robust and reduce volatility. And like in portfolio management, I think ESG should be holistic. Divestment in this asset class will not make sense, so avoid divestment. Implement active engagement, potentially, elsewhere in your portfolios in stocks and bonds. But, engage within these derivatives markets to help improve the efficiency of these markets, which are absolutely necessary for the green transition to happen without any problem and in an accelerated manner. And you can implement responsible strategies in a practical sense, like, for instance, don't take physical delivery when you are investing in futures. Avoid physically backed commodity products that hoards the commodities away from economic use and creates unnecessary scarcity in the economy. Avoid trading strategies that create these feedback loops or excess volatility, like potentially trend following strategies, but instead really be a liquidity provider with a value mindset, right? In other words, promote trading that gives pricing signals and that shapes forward curves that can be used for planning, that can be used for risk management. And wherever you can demand from these exchanges these greener alternatives or green traceable commodities, and be ready to accept their liquidity costs and be part of this transition. I think what I would like to finish saying that we are literally not crowning the asset class with an ESG status here, but definitely regarding the futures-based investments, this may not be as ESG negative as many think, and this may offer potential ways to be implementing these responsible investing ideologies. So last word, I guess I should finish with, when implementing ESG, don't forget the ESG, right? Energy, softs, grains. There I said it. Okay, I think it's a bad joke, but okay, I'll take the blame on this one.
All right. That is a terrific way to end, Hakan. I love that. Thank you very much for sharing the new ESG, energy, softs, and grains. I can't let you both go without a quick bonus question. Hakan, Sarah, we're recording this episode in the beginning of the summer, so I'd like to ask each of you if you could share a favorite memory or tradition from summer from your childhood as it relates to this very fun and special time of the summer.
Sure. I think summers are great. I remember from my childhood, summer I associate with going to beach and having fun. So it's hopefully with learning more about these ESGs, I will go have more fun in the beach with a clear mindset.
Well, and Hakan, just to clarify, these beaches in Turkey, and if so, which is your favorite beach where you grew up in Turkey?
Yeah, I like close to my hometown, there's Çeşme. It's very nice, clear water, sandy beaches also like Bodrum and Marmaris. These are like I guess I shaped my favorite childhood memories.
Lovely. Sounds very nice. Sarah, what about you?
Yeah, do you know what? It's so funny because we were literally talking about this coming up in the lift, and Hakan is obviously newer to the UK than I certainly am. We were talking about holidaying in the UK. For me, my childhood was holiday in the West Country, so I used to go to Cornwall and have the fondest memories of getting stuck in traffic jams past Stonehenge, if any of our viewers know that part of the world, and then eating Cornish pasties in the rain. But just blissful memories, very, very happy memories. Yeah, that would definitely be mine.
That's fair. I grew up in the UK as well, and my favourite thing about summertime was a softie ice cream with a flake, the chocolate flake inside, which we don't get in the US. And that's something that I always fondly remember from the summertime in the UK. Thank you, Sarah and Hakan, for joining me today. This has been a fabulous conversation. There's so many takeaways. Maybe quickly just to summarize a few of them. Hakan, you mentioned the opportunity with commodities, not just as an inflation hedge and for diversification purposes, but just in summary, commodities offer, you said, an unreplicable investment solution to making portfolios more robust. But when it comes to the integration of ESG within commodities, there's a complexity there that requires really thoughtful and logical thinking behind it, which clearly the two of you have spent a lot of time thinking about. As you said, for this to take place properly, it's going to need holistic engagement and ownership across multiple different players, the exchanges, regulators, sovereigns, market participants, really across the entire commodities ecosystem. But as you both said, there's a lot of great potential here. Sarah, you mentioned your authentic excitement about everything that could come to follow. So we really look forward to seeing what comes from this intersection of ESG and commodities. Thank you both again.
Thanks, Anu.
Thank you.
And to our listeners, if you've enjoyed what you've heard today on Disruptive Forces, you can subscribe to the show via Apple Podcasts, Google Podcasts, or Spotify, or you can visit our website, www.nb.com/disruptive forces for previous episodes, as well as more information about our firm and offerings.
This podcast contains general market commentary, general investment education, and general information about Neuberger Berman. It is for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. This communication is not directed at any investor or category of investors, and should not be regarded as investment advice or a suggestion to engage in or refrain from any investment-related course of action. All information is current as of the date of recording, and is subject to change without notice. Any views or opinions expressed may not reflect those of the firm as a whole. This material may include estimates, outlooks, projections, and other forward-looking statements. Due to a variety of factors, actual events or market behavior may differ significantly from any views expressed. Please refer to the disclosures contained in the episode notes and episode details, which are an important part of this communication. Investing entails risks, including the possible loss of principal. Past performance is no guarantee of future results.